Best Buy has been a public company for over 35 years and has come out of the pandemic with strong growth. The company's stock has pulled back quite a bit recently, and in this video, we'll be analyzing the company to see if it's a strong potential investment. I frequently look to Warren Buffett for investing inspiration, and this is one of my favorite quotes: to be fearful when others are greedy, and greedy when others are fearful. And I think the market is showing a lot of fear around Best Buy right now. So if it looks like a strong company and that the price might be good, it may be a perfect time to get greedy here. Looking at the long-term chart, I think this tells a story of an incredibly resilient company that has survived the rises and fall of cassettes, CDs, and DVDs. And maybe more noticeably for an investor, it survived the dot-com crash, the 2008 financial crisis, and the recession, the 2020 COVID pandemic, and the rise of Amazon, all while growing substantially. So the first thing we need to do is score it based on quality. So we've got 5 factors that we look at here. First is return on invested capital. We look at their 5-year average. Second, we'll look at what I call the DMC number. This is their payout yield, the dividend yield, plus their buyback yield, plus their projected dividend growth rate. The higher the number here, the better. Third, we'll look at the Simply Safe Dividends Dividend Safety Score. Basically, this looks at a bunch of different factors that we'll dive into to decide how safe this company's dividend is. Then we'll look at the growth rate, the projected earnings growth rate for the company. And lastly, we're going to look at their moat. How strong is this company's competitive advantages? And we're going to combine these 5 things to form an overall quality score. And while we're doing this, if you could like and subscribe, that would really help the channel out. First, we're going to look at return on invested capital. For Best Buy, this is almost through the roof. 24.82% is nearly double the market average. Additionally, I was a little bit suspicious when I saw this, but when you dig into it over the years, this isn't due to some spike that they got from the pandemic being really good to them. This has actually been consistent growth over many years. So they've been doing better and better at improving their ROIC over time, and it's been very consistent over time. So this isn't like one outlier pulling up an otherwise average return on invested capital. This is really solid. In my scoring system, a ROIC above 20% is good for 5 out of 5 points, which is really great for Best Buy. It shows that they're really good at taking their earnings and reinvesting it in the company to grow their future earnings, which is essentially like watering your money tree. It's really, really great to see a high ROIC here. Next, we're going to look at that DMC number that I spoke about earlier. It's 27.33. This is, again, really surprisingly strong. So dividends tend to be consistent from year to year. They tend to be the same until they raise it a little bit, and then the same until they raise it a little bit. This is pretty true for most companies. However, buybacks are much more lopsided, where a company will buy a lot back, but there's no pressure on them to immediately issue a new buyback. So they tend to be like they spike up and spike back down. And because of this, I cap the credit that I give for buybacks at a 3%. But recently, Best Buy has been doing quite a bit more. So this 27.33 is including the fact that I've already capped their buybacks lower than they've actually done. This again is going to be 5 points out of 5. They have a 4.33% dividend yield, plus they're buying back stock, plus they've got a 20% 5-year average dividend growth rate. All of that together, we're looking at it to be over 20 for that 5 out of 5. It is well over 20. This part of the company, their ability to grow their payout to shareholders, looks absolutely spectacular. Next up is the Simply Safe Dividend score. So 80 out of 100, that's quite good. That's good for 4 out of 5. We look for it to be above 90 to get that 5 out of 5 points. And so let's dig into what goes into that score a little bit. So they've paid a dividend without a cut for 18 consecutive years, including through the 2008 recession. And speaking of that recession, while their stock price fell quite a bit at minus 49%, they actually grew their sales during that time. So the company got stronger while the price got cheaper. I think that's a nice little note to have in the back of our heads with all of the talk of a potential upcoming recession. Looking at the other safety factors, they have reasonably low debt, a forward payout ratio of 39%, which is pretty low. So it looks like both of these are safe and that the company can continue to grow its payouts for the foreseeable future. Now we want to look at projected EPS growth rates. So I average a series of different analyst estimates to try to get to what I think is a reasonable estimate for how much they're going to grow year over year. Best Buy is currently at 7.03% in that average. This factors in a pullback from the recent recession-related boost. On my scoring scheme, this is good for 2 out of 5 points. It's pretty close to that 3 out of 5 points, which the threshold for which is 7.5%. This is the weakest of their quality scores, but I think a 7% EPS growth for a company over the next couple years that accounts for a potential pullback in the short term is pretty good for it to give us an ample total return, assuming the price is also fair. So I expect they're going to continue to compound growth for the long haul. This isn't super concerning, but it is one to keep an eye on. Lastly, for our quality score, we'll look at moat. Morningstar assigns a narrow moat to Best Buy, which is good for 3 points. So the scoring schema here is 5 points for a wide moat, 3 points for a narrow moat, 1 point for no moat. And the moat's also considered stable, which is great. Moats in retail can be tricky. Some areas like Home Depot and Lowe's have nearly unassailable wide moats, while others like Target have no moat at all. But Best Buy has been doing a great job building out a customer experience and services offering that make it hard to conquer with online retail and also hard to assail with traditional brick and mortar. So I don't see this moat going away anytime soon, and I feel pretty good about it overall. So let's take a look at our summary of quality. We've got 19 out of 25 total points, which is 76% of available points, which in my mind is exactly the threshold for which I'd make a company go from good to wonderful. So it's really, really in there at a good spot. And again, that one thing pulling it down is the projected EPS growth going forward, but it's still going to grow at quite a nice clip, despite the recent bump from the pandemic. So I look at this as a really, really solid company from a quality point of view. Next, we need to take a look at value or price. So we have 4 things we look at here. First is the PEGI, so price to earnings over growth plus payout yield. So you might have heard of PE ratio, that's price to earnings, or PEG, which is price to earnings over growth. And I use PEGI, which is price to earnings over growth plus their payout yield. So things like dividends and buybacks, the cash they return to shareholders. Next, we're going to look at the price versus an average analyst fair value price for the company. Third, we're going to look at the Morningstars. So what's the Morningstar rating for the price? That's a 5-star system. And lastly, we'll look at a discounted cash flow analysis that I then add a margin of safety to and multiply by 0.85, basically to pare that back a little bit. You'll notice that while we have 5 quality scores, we only have 4 price scores, which will slightly weight our total score in favor of quality, which I think is a good thing. I like the Warren Buffett adage of far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So I think a little bit of a quality lean without being overpoweringly so is a pretty solid way to evaluate companies. Okay, let's jump in. First, let's look at the PEGI. It's a 0.58. That's good for 5 out of 5. We're just looking for it to be below 1 there. It's really strong. Their PE is almost absurdly low here, 8.09, with the projected earnings growth of 7.03, plus the current dividend of 4.38, plus buybacks. Again, I cap at 3 here, but if you wanted to be less conservative there, you could use an even higher number because they are buying back more than 3% a year. It's really just a great sign for value here. Out of the gate, we're coming out strong. Next, analyst fair value. The average analyst fair value here from a series of top analysts was $97. We're currently 20.66% below fair value there at an $80.39 current price, which gives us over a 20% difference, which is the threshold I use for 5 out of 5 points here. So again, another really strong indicator that this is quite underpriced. Next up, Morningstars. So we've got this is a 4-star company from Morningstar's rating. The 5-star price here is $75.60. So we're pretty close to that 5-star price as well. Again, I like to see lots of different evaluations pointing to a similar thing. So we've got that quantitative PEGI ratio saying this is good. We've got the analyst's estimates saying this is good. We've got Morningstar's independent analysts saying this is good. And let's look at this last, this DCF valuation. So I use Finbox's 10-year EBITDA exit DCF for most companies, and Best Buy definitely falls into the bucket for which I use that. Discounted to 85% of that, Best Buy would have a fair value of $137.20, which is a 70%, over 70% gap from today's price. So that is definitely good for another 5 out of 5 points. really pointing to a strong series of scores for Best Buy from a value POV. So let's recap that. That is 19 out of 20 for value. The only point we missed there is it's a 4 out of 5 Morningstar instead of 5 out of 5. And it's not too far off the 5 out of 5. If we get another pullback, that becomes an even nicer price. In fact, a perfect score. Okay, so let's recap the overall that we got going here. Our scores, we had a 19 out of 25 for being a wonderful company. And we had a 19 out of 20 for being a wonderful price. These are both in my range for being wonderful scores, as opposed to good or great or fair. So this is really, really solid. And the biggest point loss was due to that projected earnings growth of being only 7%. So if you wanted to do more research here, I would really dig into what we think the long-term earnings are going to be. I think the 7% is fair over the next 3 to 5 years. You could dig in a little more to see if you think what that's going to be like after that period. This could be a really strong long-term hold. They've also got a new, or recently have got a new CEO who's been with the company a long time and through a lot of these transformations. So there's not too much skepticism as to whether or not they're going to be able to continue to contend in retail, but it is something to look into. Overall, by my scoring system, it's a wonderful company at an even more wonderful price. It's a resilient one that has survived decades of innovation in retail. It's currently got a high yield and high growth. As always, you should do additional research yourself before purchasing any stock, but from my perspective, Best Buy looks amazing. Thanks so much for watching, and I'll see you next time.